Hello and welcome to the show. Bulls have gone missing from D Street this week as indices came under once again intense selling pressure despite some short-lived, short-covering rallies. It has been volatile indeed. Some of the three key themes that stand out this week. First half on record for the Sensex came off more than 35%, lost market cap to the tune of 27 lakh crores. You had inflation at a 13-year high, so it's not abating at 11.63% on Friday, and crude keeps making a record as hours go by. And the third, of course, has been the local government and some kind of stability or semblance of a deal finally coming in, which was a bit of a respite and relief. Two market veterans join me on the show today. Mihir Vora, Head of Fund Management Equities, HSBC Mutual Fund, and Surjit Bhalla, Managing Director, Oxis Research and Investments. Thanks very much, gentlemen, for joining in here. Let me start with you, Surjit. Has the bad news been overdone?
Well, it certainly looks that way. You know, there is not only, what I want to emphasize is not only bad news as far as India is concerned, but there's been bad news as far as the world is concerned. And around the world, certainly the feeling is that it's been a little bit overdone. So we shouldn't look at this as particularly an Indian problem in terms of both analysis and forecasts of what's likely to happen. We should look on this as a global phenomenon where practically no market outside of oil investors have made any money. They've not made money in fixed income, they've not made money certainly in equities, they've not made money in commodities other than oil, because all of those have shown a correction of between 10 to 20%. So, you know, things are not looking right, have not looked right for world markets the last few months, if not the last 6 months. And to answer your first question, is enough of it already? Yes.
Mihir, let's get to numbers in terms of a Sensex target, and there have been some downgrades coming in from international as well as domestic brokerages and investors in this week. 10,000 has become a common refrain as well.
Well, I would say to a great extent it all depends on what happens on the commodities front, especially oil, frankly speaking, because you will see market earnings growing for FY09 and FY10, but if commodity prices stay the way they are, then my guess is that a lot of the earnings growth will actually come from commodities-linked companies and commodities-linked sectors, which tends to be a little lower PE overall in terms of the valuations. So you might see earnings growth coming through, but then the market expected PE would come down. 10,000 is not something that I would like to wager on, frankly speaking, because as Surjit did mention, we have seen a very, very sharp fall in the last few months. The velocity of the fall has been very fierce. So to in my opinion, to a great extent, a lot of the negatives that we are talking about, current inflation, current oil prices, current interest rates, which are all linked to each other, have been discounted to a great extent. We must not forget that stocks, blue chip stocks in the infrastructure sector, in the real estate sector, in the banking sector are down anywhere between 50 to 80%. So obviously a lot of value is being created at this point in time in terms of opportunity that one can use to pick stocks. Whether the market goes to 12,000 or 13,000 or 10,000 is really a matter of timing. But if you leave the timing element aside and start investing in a staggered fashion from this point in time, I'd say over the next 2 to 3 years we'll end up making money rather than losing money from these levels.
Suji, let's come to what possibly, if you want to narrow it down, is the biggest concern right now. Inflation at 11.63% and inflationary expectations, I think, which are more the worry right now. Will it just continue to eat up growth?
You know, look, I mean, going back to your first question and this, that markets, and if you're talking about stock markets, are supposed to discount the economy in the future. Now, the present economy is very bad. Let's say the economy gets worse over the next 3-4 months. What analysis of at least the US market tells us is that markets act about 3 to 6 months before the economy bottoms out. So if one is looking at it from that perspective, even assuming that information about the inflation, etc., gets worse from now on, you still come out with that, and given that the price decline has been vicious and large, and for most sectors, as was just pointed out, 50% or more, that I think, there is, to talk about 10,000, which is another 25-30% from here, seems to me somewhat in the outlandish camp. Now, outlandish things have happened, okay? Oil is at 145. But to keep predicting that, every month the world economy and the Indian economy will see a black swan is, I think, playing with probability in a manner that is not very profitable. Or is likely to be not very profitable, even though you will see one black swan in your lifetime. So having said all that, I just think coming now to the Indian economy, inflation news can't get worse. I mean, we're already at 11-12%. So what's 1% between friends? So, it comes out 13. Is it much different than 11? No. Is it much different than 10? No. What will make a difference to inflation is the price of oil, and that will also affect inflationary expectations. People are making comparisons to the 1970s when the world was, quite frankly, radically different. The commodity prices in the 1970s went at least 2 to 3 times higher in real terms than they have done today, excepting oil. So no matter how you slice it, I think we are very close to the end of the bad news, which does not mean, I'm not saying good news starts tomorrow, but I think over the next 3 months or so, you should begin to see good news coming. And if the oil price were to correct itself in the near future, rather than in the 6-month future, I think world and markets will look very different.
Mihir, how are you placing yourself in terms of oil right now? Because even if you're investing in equities, you cannot ignore that, as Sujit's been pointing out, and we've been seeing the direction of market movement versus crude prices is completely opposite.
Oh, absolutely. It's all about oil, as I would say, and as everybody, says. To that extent, over the last 6 months or so, we have been, shifting the portfolio away from the